Imagine a single company powering almost every major breakthrough in artificial intelligence, from ChatGPT to self-driving cars, from cloud data centers to the future of robotics. That company is Nvidia. And just hours ago, Nvidia reported its latest earnings. The numbers are massive, but so are the warning signs. We're talking record-shattering revenue, a jaw-dropping profit margin, a $60 billion stock buyback, and at the same time, geopolitical risks with China, slower growth momentum, and investors like Peter Thiel warning that this could be the next dot-com bubble. So what really happened in Nvidia's second quarter of fiscal year 2026? Why did the stock drop even after beating expectations? And most importantly, what does this mean for the future of AI and for your portfolio? Stay with me, because over the next 10 minutes, we're breaking down everything you must know from Nvidia's earnings: the numbers, the risks, the opportunities, and the outlook. Before we start, if you're getting value from this video, please subscribe to the channel. We just passed 70 subscribers, so a huge thank you to everyone who's followed the investment diary. Let's start with the headline. Nvidia absolutely crushed it again. Revenue for the quarter came in at $46.7 billion. That's not just a number, that's a 56% jump compared to the same quarter last year. To put that into perspective, most Fortune 500 companies would celebrate if they grew revenue by 5 to 10% in a year. Nvidia just did over 50% in one quarter. And it didn't stop there. Adjusted earnings per share came in at $1.05, edging past analyst expectations of $1.01. It might sound like a small beat, but when you're talking about billions of dollars in profit, every penny per share is worth hundreds of millions. Now let's talk bottom line. Net income, that's pure profit after expenses, hit $26.4 billion. That's up 59% year over year. Few companies in history, not even Apple at its peak, have posted this kind of profit acceleration in such a short span of time. And the margins are in a league of their own. On a GAAP basis, gross margin was 72.4%. On a non-GAAP basis, 72.7%. For context, most semiconductor companies run in the 40s or 50s. Even the tech giants like Apple or Microsoft don't usually post margins above 70%. Nvidia isn't just making money. It's printing cash with efficiency that rivals the most profitable business models on Earth. Even after adjusting for some accounting noise related to H2O chip inventory, margins barely moved. The message is clear. Nvidia's business model right now is almost bulletproof. This is not just a strong quarter. It's a statement that Nvidia continues to operate on a completely different level from almost every other company in the market today. Now, let's talk about the engine that powers Nvidia's growth: the data center business. This segment alone pulled in $41.1 billion in revenue. That's up a staggering 56% compared to last year, and still climbing 5% sequentially. Think about that. The world's biggest companies, from Amazon to Microsoft to Google to Meta, are spending billions building AI infrastructure, and almost every dollar runs through Nvidia's hardware. The company has become the picks and shovels supplier of the AI gold rush. But here's the twist. Despite the jaw-dropping numbers, Wall Street expected just a little bit more. Nvidia's data center revenue came in slightly below forecasts. On paper, it's a rounding error, but remember, this stock is priced for perfection. When expectations are high, even a minor shortfall feels like a disappointment. And that's exactly why we saw the stock slip in after-hours trading. Investors weren't reacting to weakness. They were reacting to the fact that Nvidia, for once, didn't exceed every number by a mile. It's a reminder that the higher a stock flies, the thinner the margin for error becomes. Nvidia is so dominant, so profitable, and so essential to AI right now that anything short of blowout looks like a miss. Still, let's be clear. Nvidia's data center quarter is not just healthy, it's historic. It tells us that Nvidia remains the core infrastructure company for the AI era. The slight miss is more about Wall Street's perfection obsession than Nvidia's execution. Now let's tackle the elephant in the room: China. For months, investors have been asking, can Nvidia keep growing if it loses access to one of the world's largest AI markets? Here's the reality. This quarter, Nvidia reported 0 shipments of its H2O AI chips to China, none. And importantly, the company isn't including Chinese sales in its guidance for the next quarter either. Why? Because of U.S. export restrictions. Washington is walking a fine line, allowing Nvidia to apply for licenses to sell into China, but only under strict conditions. One of those conditions? Nvidia would need to hand over 15% of revenues to the U.S. government on any licensed sales. That's a steep toll. But here's the kicker. If those sales do resume, analysts estimate Nvidia could see an additional $2 to $5 billion in revenue upside. That's not pocket change. That's the size of some entire tech companies. But for now, China is a big question mark. On one hand, the lack of sales don't appear to be slowing Nvidia down. Demand in the US, Europe, and the Middle East is more than enough to keep factories at full tilt. On the other hand, every headline about US-China tensions creates headline risk for the stock. So the takeaway is this: Nvidia is showing it can thrive even without China. That's a huge vote of confidence in the durability of its AI monopoly. But if, and it's a big if, China comes back online, we're talking about billions of dollars of untapped growth sitting on the sidelines. In other words, China is not the lifeline, it's the bonus level. Now here's where it gets really interesting for investors. Not just what Nvidia's earning, but what it's doing with that cash. Despite the macro challenges, despite China risk, despite sky-high expectations, Nvidia just made one of the boldest statements a company can make. The board approved a $60 billion addition to its share repurchase program. Let that sink in. $60 billion. That's one of the largest buyback authorizations in corporate history, larger than the market cap of entire S&P 500 companies. And they're not just authorizing it, they're using it. In the first half of fiscal year 2026 alone, Nvidia has already returned $24.3 billion to shareholders through a combination of buybacks and dividends. So what does this mean? 1. Management confidence. You don't buy stock at all-time highs unless you believe the future earnings power justifies it. Nvidia is sending a message loud and clear. They think this ride is far from over. 2. EPS booster. Every share they retire makes the earnings per share number look even stronger going forward. This cushions the stock if growth ever slows, and it creates a floor of support for investors. 3. Capital return leader. Nvidia is no longer just a hyper-growth story. It's now acting like a cash machine, rewarding long-term holders in the same way Apple and Microsoft have done. Think about this. The company is literally minting so much cash that it can reinvest billions into R&D and still hand tens of billions back to shareholders without breaking a sweat. For investors, that's the dream combination: growth plus return of capital. This isn't just Nvidia saying we're strong. This is Nvidia saying we're a fortress. Looking ahead, Nvidia guided third-quarter revenue of about $54 billion plus or minus 2%. That's slightly above Wall Street's estimate of $53.4 billion. But here's the kicker. This guidance does not assume any China H2O sales. In other words, Nvidia is basically telling the market, even if one of our biggest regions is off the table, our growth machine keeps humming. That's almost unheard of a level of strength. But it doesn't stop there. On the macro vision, Nvidia laid down a jaw-dropping projection. By 2030, the world will spend between $3 and $4 trillion on AI. Trillions, with a T. That's the scale of the digital revolution we're in the middle of. And Nvidia wants to be the picks and shovels supplier to every miner in that gold rush. Now, let's not get carried away, because even the strongest companies face storm clouds. Valuation risk. Nvidia is already trading at a premium multiple. At these levels, perfection is priced in. If growth even slightly slows, the stock could correct hard. Competition. AMD, Intel, and custom chips from hyperscalers like Google and Amazon are nipping at Nvidia's heels. They won't sit idly by while Nvidia dominates. Geopolitics. U.S.-China tensions could escalate further. If China restrictions deepen, Nvidia could lose a significant revenue stream. And cyclicality. Semiconductors always have cycles. At some point, demand will cool. Maybe not tomorrow, but eventually. So yes, the story is powerful, but investors need to keep both eyes open. Here's the bottom line. Nvidia is no longer just a chip company. It's become the backbone of AI, a cash-printing fortress with growth, buybacks, and a multi-trillion-dollar runway ahead of it. The numbers this quarter weren't just strong, they were historic. Revenue exploding past expectations, margins at record highs, shareholder returns measured in tens of billions of dollars, and guidance that shows the ride isn't slowing down. For investors, Nvidia isn't just reporting earnings, it's defining an era, the AI era. That wraps up today's episode of the Investment Diary. If you enjoyed this analysis, make sure to like and subscribe for more deep dives into the world of investing. As always, this is not financial advice, just educational content to help you make better investing decisions. Thank you for watching, and I'll see you in the next video.